In 1919, the most powerful men on earth gathered in Versailles to divide the world after the bloodiest war in history. They drew borders, they assigned blame, and they handed Germany a bill, 132 billion gold marks, that economists immediately called impossible to pay. They were right, Germany couldn't pay it. And the attempt to collect that debt would trigger hyperinflation, the collapse of democracy, the rise of Adolf Hitler, and a Second World War that killed 70 million people. One debt, one decision, half a century of catastrophe. That's not a footnote, that's the hidden engine of modern history. Because behind every war, every empire, every revolution, if you follow the money far enough back, you find the same thing: a promise, a creditor, and a reckoning. This is the history nobody taught you, and it starts not with politicians or generals, but with a room full of London merchants in 1694. England was losing a war it couldn't afford. King William III needed gold to fight France, and there was none left in the treasury. So his advisors proposed something that had never been done at this scale before. Instead of taxing the present, they would borrow from the future. A group of merchants agreed to lend the crown $1.2 million, a staggering sum, in exchange for guaranteed annual interest payments backed by the government itself. To manage the arrangement, they created a new institution, the Bank of England. It was, on the surface, a simple financial transaction, but in reality, it was a revolution in how power worked. For the first time in history, a government could spend money it didn't yet have. And crucially, it could do so not by debasing its coins or looting its colonies, but by selling a promise, a document, a bond, a piece of paper that said, "Trust us, we will pay." What made it revolutionary was that people believed it. France had a larger army. Spain had the silver mines of the Americas. But England had something more durable than gold. It had credibility. And within a generation, that credibility became the foundation of the most powerful empire the world had ever seen. The Dutch had pioneered the concept decades earlier. Amsterdam's merchants had financed wars and trade routes through bonds and shared risk. But England scaled it into something new, a permanent national debt designed not to be erased, but to be managed. A living financial organism that would grow alongside the empire itself. The battlefield had become the balance sheet. Once the British understood what they had built, they used it ruthlessly. While rivals drained their treasuries on single campaigns, Britain could finance decade-long wars, return home, issue new bonds, and go again. The 7 Years' War, fought across 5 continents between 1756 and 1763, was, in many ways, won not on the battlefield, but in the London credit markets. Britain borrowed more, faster, and cheaper than France could. When the guns fell silent, Britain held Canada, India, and dominance over global trade. Napoleon understood the danger. He called Britain a nation of shopkeepers, a taunt meant to sting, but which missed the point entirely. It wasn't the shopkeepers who defeated him, it was their bonds. But there was a shadow side to this power. To service debt, you need revenue, and revenue for an empire meant extraction. The same financial system that funded Britain's wars funded its slave trade. The same bonds that paid for the Royal Navy secured the plantation economy of the Caribbean. When Britain finally abolished slavery in 1833, the government borrowed $20 million, equivalent to roughly $2 billion today, not to compensate the enslaved, but to compensate the slave owners for their loss of property. British taxpayers finished paying off that debt in 2015. The architecture of modern finance was built on those foundations, and the ledger was never entirely clean. The United States inherited the British model and weaponized it on an entirely new scale. When Alexander Hamilton became the first Secretary of the Treasury in 1789, the young republic was drowning in Revolutionary War debt, owed to France, to Dutch bankers, to its own soldiers who'd been paid in near-worthless paper. His colleagues argued for default. Hamilton argued the opposite. Assume the debt, all of it. Pay every creditor. Make the promise unbreakable. His reasoning was geopolitical before it was financial. A nation that honors its debts becomes a nation that can always borrow more. And a nation that can always borrow more, can always fight longer, build faster, and outlast its rivals. Hamilton didn't see debt as a burden. He saw it as infrastructure. He was right. And the consequences echoed for 2.5 centuries. By the time of the Civil War, the Union funded its survival through bond drives sold directly to ordinary Americans. Jay Cooke, the financier who managed the campaign, essentially invented mass retail banking in the process. The Confederacy, unable to access the same credit markets, printed money and collapsed into inflation. The war was decided as much in the bond markets of Philadelphia as on the fields of Gettysburg. The 20th century then handed America something no empire had ever possessed before. After the Second World War, with Europe in ruins and the dollar backed by the largest gold reserve on earth, the Bretton Woods Agreement made the dollar the world's reserve currency. Every nation on earth now needed dollars to trade. And to get dollars, they needed to buy American debt. America had turned its own IOUs into the global oxygen supply. But here's what empires always discover too late: the debt that builds you can also unmake you. Versailles was the first modern lesson. The reparations imposed on Germany weren't just punishing, they were structurally impossible. Germany's economy couldn't generate the surplus needed to pay while simultaneously rebuilding. When the Weimar government printed money to cover the gap, hyperinflation destroyed the middle class, wiped out savings, and created the economic despair that gave extremist politics its opening. History didn't just rhyme, it screamed. The second lesson came in 1956. Egypt's Nasser nationalized the Suez Canal. Britain and France invaded. Within days, the United States threatened to dump its holdings of British pounds on the open market, which would have triggered a currency collapse. Britain, once the world's great creditor nation, was now a debtor dependent on American goodwill. They withdrew. The age of European empire ended not with a battle, but with a phone call about bond markets. The third lesson came from the developing world through the 1970s and 80s. Western banks, flush with petrodollars after the oil shocks, lent aggressively to Latin America and Africa. The loans were cheap at first. Then American interest rates surged. Suddenly those debts cost twice what they had. Country after country, Mexico, Brazil, Argentina, Nigeria, found themselves unable to service loans they'd taken out for schools and roads. The IMF arrived with rescue packages, but the rescue came attached to conditions: cut public spending, privatize state assets, open your markets, a generation lost to austerity, structural adjustment programs that restructured entire societies in favor of creditors thousands of miles away. The creditor is always invisible until the debtor misses a payment. Then they're very visible indeed. Today, the numbers have grown beyond anything Hamilton or the Bank of England's founders could have imagined. Global debt now exceeds $315 trillion, nearly 3 times the entire output of the world economy. The United States alone owes $38 trillion. Japan's debt exceeds 250% of its own GDP. And yet, the machine keeps running. Why? Because sovereign debt, particularly American debt, was never really about repayment. It was about trust. A US Treasury bond isn't a liability in the eyes of the market. It's the most trusted asset on earth. Pension funds hold it. Banks use it as collateral. Central banks treat it as a near equivalent to money itself. If Washington somehow paid every dollar of its debt tomorrow, the world's financial system would seize up. The most stable collateral in global markets would vanish overnight. The very act of repayment would be catastrophic. So the plan, never stated openly, universally understood, is not to repay. It's to roll the debt forward, issue new bonds to cover old ones, and keep the interest flowing. Governments treat debt like a permanent subscription. The principle is not the point. The confidence is the point. This is, when you step back, an extraordinary historical achievement. The modern world has built a financial architecture so sophisticated that debt itself has become the foundation of stability rather than a threat to it. England's 1694 experiment, scaled up across 3 centuries and every continent, has become the invisible skeleton of civilization. But skeletons are only invisible when the body is healthy. Greece in 2010 showed what happens when confidence breaks at the national level. Sri Lanka in 2022 showed what happens when a smaller nation runs out of foreign currency and can no longer import fuel. Argentina has defaulted 9 times and counting. Each time the same sequence: panic, collapse, IMF, austerity, reset. The system doesn't fail permanently because it's ingeniously designed to restart. Old debts get restructured, new loans replace them, different names on the same balance sheet. But there is a deeper question that history keeps posing. Debt, at its core, is a claim on the future. On future labor, future taxes, future growth. And the people who service that debt are rarely the people who took it on. The interest payments that flow through this system don't flow equally. They flow from taxpayers to bondholders, from the global south to the north, from workers to institutions. Every crisis reshuffles the deck. The house always takes its cut. England borrowed to build an empire. Germany was crushed by a debt it couldn't pay. America turned its debt into the world's reserve currency. And the developing world borrowed to grow and found itself governed by the terms of its own loans. The geography changes. The names on the balance sheet change. But the oldest truth in financial history never does. Whoever controls the debt controls the future. And the question worth asking, now more than ever, is who exactly is writing the terms?